The latest unemployment report from Australia showed the number of people in full-time work fell by 31,600 in December. Immediately after the report, the Aussie dollar dropped to a 4-year low. Joining me down the line to discuss what repercussions this could have for future monetary policy, the dollar and the economy as a whole is Sebastien Galy. Sebastien, Australia had jobs growth of only 0.5% throughout the year. At that rate of growth, you should be seeing the unemployment rate moving higher, but the overall jobless rate actually stayed at 5.8%. Analysts cited an element of ageing population and people retiring, but there would also seem to be an element of people giving up as well. Therefore, similarly to the US, is the participation level the most worrying thing here?
Yeah, if you imagine that there was a big baby boom globally, that generation essentially is retiring. So what you're seeing both in Australia, the US, and other countries is the participation rate is essentially falling. Why? Because older people generally work less. They retire, not all of them, not completely so, but they tend to work less, and the consequence is basically that move in the participation ratio. So that's hiding basically some of the unemployment, or the unemployment seems better than it actually is, because it is a very partial measure of what's happening in the labor market.
Despite the soft data, analysts don't think today's number will sway the RBA to cut again, believing the central bank would probably want to see the Aussie dollar do most of the work in further easing monetary conditions. What do you think, Sebastien?
Yeah, I think that it's a very fair point, and to help things along, the market loves to be given a direction, and the data is certainly helping, but the central bank, of course, is helping it along. It's happening for commodity currencies broadly. It's happening for Canada, Australia, happened earlier for Norway and the like. So they're trying to guide their currencies lower, and the reason behind it is that they essentially are not productive enough and are too expensive. What happens is it's very difficult to deflate an economy internally. That is,
traders and analysts remained mindful of the downside risks to growth and employment in the second half of 2014, as mining investment declined more markedly, particularly with little evidence as yet of an impending pickup in non-mining investment to fill that void. There have, however, been stronger numbers from China of late, so is it all really doom and gloom, do you think?
Well, that's why it's complex to trade Aussie, because it's not a linear process. So if you could imagine that the way to trade Aussie is traded as a band. It's going lower as a band, and you want to sell it when people are very excited about it on the positive side, and a similar way on the downside. And basically, it's a downward trending band. And of course, some of the data out of China has been better, but if you look at some of the credit events that are happening right now in the shadow banking sector in China, clearly you have evidence that there's a form of tightening with partly intended and unintended consequences on credit in China. Mining boom it peaked a long time ago. That effect is being felt now. So it's essentially what we're seeing in Australia and the likes is a lagged effect of the slowdown in China a while ago. And what you're seeing is the Chinese event is continuing to percolate, and these will continue to percolate into Australia, but not now, but many months, even a year down the road. So the negative pressure coming out of the commodity sector will continue for quite a while, and it'll take a while basically to get that rebound. For that, we need the U.S. economy to do well, other economies around the world to do quite well. And we might have to wait for 2015 and 2016 for a reversal of that very bearish story. On the commodity side, a lot of it has already been priced in, so it's mostly range trading from a commodity point of view, but eventually it'll turn around.
The lack of a bounce in the currency heading into the European trading suggests further selling may ensue. What is your longer-term outlook for the Aussie dollar against its US counterpart?
Well, we're having good, heavy discussions internally, and how badly we want to short it. I think that's pretty much how the market feels about it. Is really what level you want to short the currency, and expecting when the dollar to rise and the Aussie to continue to fall. So this is really our essential core strategy, to wait for any rally to basically sell into it. And even if we see a significant correction low in Aussie dollar, it still offers some opportunities to put in some lighter short position on the Aussie side. Now, eventually, we will reach the bottom of that range on the Aussie dollar side. We may not have reached it yet, so there's still maybe some opportunities on the downside. But it's quite interesting. I mean, if you think, for example, that in a few weeks' time we'll have non-farm payroll in the U.S., which probably will be about 300,000. that generally is very good for the dollar. It's generally not good for commodity currencies because when they have the commodity side is dollar-based, they have a double hammer on that side. And that means the dollar could rise far more sharply against currencies which are less in favour. The Aussies is certainly one of them.
Sebastien, once again, great to have you on the show. Thank you very much. Well, viewers, that's all from me at the moment, but if commodities are your thing, make sure you click back for today's Commodities Corner with Thomas Taplin, focusing on base metals. Goodbye for now.